Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at DigiXX.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave in the comment section below.
So let's get into the analysis.
The big story here really is this massive operational shift they've pulled off.
It really is. I mean, they've made a very decisive, very strategic pivot right into high-performance computing, HPC, and AI infrastructure. They're moving away from their legacy stuff.
And it seems like the entire focus now is on their AI-ready data center platform, right? The one run by their U.S. data centers subsidiary.
Exactly. And, you might think, okay, another data center provider, it's a crowded space. But they have a real competitive edge, a moat.
Which is what separates them.
They're vertically integrated, and that's the key. They don't just provide the data center, they own the entire power stack.
So they own the power plants themselves.
They own the power plants, the infrastructure, everything. And they use these next-gen modular data centers, like their ARMS 200 solution.
Okay, so if I'm a big AI company, why do I care that they own the power plant? What does that actually mean for me?
Well, it solves the single biggest problem in AI compute: the cost and reliability of energy. Most cloud providers have to buy power on the open market.
Which is volatile and risky.
Extremely. DigiXX just bypasses all that. By controlling everything from the power generation right to the server rack, they can offer much lower and much more stable deployment costs. That's a huge deal in this industry.
So the energy itself becomes part of the product, not just a cost. And this whole model just got a massive vote of confidence, didn't it?
A huge one. The big catalyst was their subsidiary getting Tier 3 certification for the AI platform.
And Tier 3 isn't just marketing speak, right? It's a specific technical standard.
It's a critical standard. It guarantees 99.982% uptime. For anyone listening, that basically means it has full fault tolerance. You have backups for your backups, multiple power, cooling, and network redundancies.
So if a power line gets cut, the AI model doesn't just stop training.
Precisely. And when you're training a huge model for weeks, an unexpected shutdown can be catastrophic. We're talking millions of dollars lost. So this certification tells big institutional clients that DigiXX is playing in the major leagues.
And the market loved it.
Oh, yeah. That news alone sent the stock up 8.3% on November 2nd.
Okay, so let's talk about the growth they're promising. Because the numbers they're pretty aggressive.
They're staggering. So right now, they've secured about 196.7 megawatts of power capacity. But the key is getting it deployed.
And the target for that is what?
The plan is to have 55 megawatts actively deployed by Q4 of 2026, and then they're targeting an eventual capacity of 195 megawatts by 2027. This isn't slow and steady, it's full throttle.
And this is all going to be powered by the latest hardware. I saw they mentioned the new NVIDIA B200 GPU cluster.
Yeah.
Why is that specific chip so important?
Because the B200 is the next big thing in AI processing. Getting those online, which they expect in Q1 2026, lets them attract the highest paying clients. Those GPUs command a massive premium. It's the difference between just renting out server space and selling elite high-end AI computing power.
Now, what's maybe the most incredible part of this story is how they're funding this, the balance sheet.
It's what makes this story so fascinating. They are completely debt-free, a debt-to-equity ratio of 0.
Which is almost unheard of in the infrastructure space, right?
But
these companies usually carry massive debt to build things.
Exactly. And in a high-interest rate world, that's a revolutionary advantage. It means every single dollar they spend on CapEx, on building out those 55 megawatts, is coming from their own cash, not expensive loans.
And they have a lot of cash to spend.
A phenomenal amount. Their liquidity just surged. As of October 31st, 2025, they were sitting on $85 million in cash, BTC, ETH, and deposits.
Now it was up from what, just a month before?
Up from $29 million. So they added $56 million to their war chest in a single month. That gives them a huge runway to fund this transition.
And we're already seeing the results on the top line in the revenue.
We are. Q3 2025 revenue hit over $31 million. That's up nearly 50% over 5 years, but the recent growth is what's really eye-popping.
Yeah, that 115% quarter-over-quarter growth in Q1 2025 was just massive.
It was, and that was on top of 41.7% year-over-year growth in 2024. It shows that this pivot is already working. Clients are signing up.
So, okay, you have this incredible picture, revenue's exploding, They're vertically integrated, Tier 3 certified, and they have zero debt. It sounds almost perfect.
Right, which means it's time to talk about the other side of the coin, the elephant in the room.
Profitability.
Exactly.
Right.
This is the core risk of the investment. For all the growth, they are still deeply in the red.
And the numbers are pretty stark. A net profit margin of negative 39.25%. EBIT margin is negative 37.4%. They're burning cash.
They are. But it's important to understand why. This is the cost of a massive CapEx cycle. They're spending a fortune to build out infrastructure that isn't fully generating revenue yet. The costs are all front-loaded.
And you see that in the cash flow, too. Free cash flow is negative, nearly $9 million. So no dividends or buybacks anytime soon. All that cash is going right back into the business.
It has to. But the mitigating factor here is their overall health. Their current ratio is 1.2, which is healthy. It means they can cover their short-term bills. That $85 million in cash is their safety net.
So the big question is, when does this turn around? Is there an inflection point in sight?
There are signs, yes. And this is what's so encouraging. Q2 of 2025 actually delivered a positive adjusted EBITDA. And then in Q3, they actually hit positive net earnings.
So we're seeing the first green shoots.
We are. It suggests that as the first AI contracts come online, they're starting to move the needle on the bottom line, even while the big build-out continues.
And Wall Street is starting to notice, right? Analyst estimates are improving.
That's right. The EPS estimates for fiscal year 2025 were just revised upward. It's still a loss, but it went from an expected loss of 55 cents to 48 cents. That upward trend is what you want to see.
Okay, let's switch gears to the technicals. Because with a story this dramatic, you expect a lot of volatility.
An incredible amount. We have to point out the stock's beta. It's between 9.72 and 9.92.
And for anyone who doesn't live and breathe this stuff, a beta of 1 means you move with the market. A beta of almost 10 means
It means this stock swings nearly 10 times more violently than the S&P 500. This is not a set-it-and-forget-it investment. It's a roller coaster.
But so far, that roller coaster has been going straight up. A 77.5% gain in the past year, and it's up 166% year-to-date. Just incredible performance.
The momentum is undeniable. From a technical standpoint, it's consistently trading above its 50-day and 200-day moving averages, which confirms a strong uptrend.
What are the key levels to watch?
Right now, you're looking at resistance around $6.65. If it can break through that, it could signal the next leg up. On the downside, you've got key support at $4.74.
Okay, so that's the chart. But what about real-world risks, things that could knock this whole story off track?
Well, you have to read the fine print in their filings. Beyond the obvious risks, like relying on a few big clients, there are some local issues, specifically these noise citations in North Tonawanda.
Noise citations.
Yeah.
From the data centers.
Yeah, from the computing infrastructure. It sounds small, but local regulators are cracking down, and that means management has to spend time and money dealing with it. It's a distraction and a potential drag on margins that they need to get sorted out.
Right. So looking ahead, what should investors be watching for over the next, say, 3 months? What's on the catalyst calendar?
The single most important date is the Q4 2025 earnings release. That's expected around December 18th.
And what's the key metric there?
2 things. First, gross margin trends. They have to keep improving. And second, the forward outlook. We need to hear concrete updates on client commitments for that new Tier 3 infrastructure. We need proof that the 55 megawatts are being sold.
And outside of the company's own announcements, there are some market-wide events to watch too.
Definitely. Keep an eye on the big ETF rebalancing that's expected right after New Year's, around January 2nd. If DigiXX gets added to some major tech ETFs, that forces funds to buy the stock.
Which creates automatic demand.
Exactly. And then around February 3rd, the big institutions have to file their holdings. That's when we'll see if the big money, the sophisticated investors, are really buying into this AI story.
And that all feeds into the speculative buzz, the rumors. What's the chatter on the street?
The biggest rumor is that they're close to finalizing a major strategic partnership. Could be to co-develop tech, or maybe, more likely, a deal with a big utility company to expand their market access.
And we also need to see those B200 contracts become official announcements, not just guidance.
That's the other big one. A firm contract for the NVIDIA B200 deployment would instantly de-risk a huge part of their 2026 plan.
It also seems like management is heavily invested in this.
Oh, absolutely. They have serious skin in the game. We're talking 1.43 million stock options and 700,000 RSUs vesting over the next few years. Their personal wealth is directly tied to hitting these targets.
So if they execute on this 55 megawatt plan, what's next? What's the long-term vision here?
I think it's all about leverage. They can leverage that debt-free balance sheet for M&A, maybe picking up a smaller tech or energy partner, and they could expand into related areas like enterprise AI services or even lean more into their crypto infrastructure business to diversify.
The story of DigiPower is clearly a high-risk, high-reward play. A company with exceptional liquidity and a leading position in the essential AI infrastructure space, but one that must rapidly convert its massive revenue growth into sustained profitability to justify its current momentum.
Mm.
That balance sheet flexibility gives management a huge advantage, but now they have to execute on those 55 megawatts and those new client partnerships.
We'll be keeping a close eye on those Q4 earnings. If you found this analysis useful, remember to subscribe, like, and comment to support Smart Wealth with Joshua. We'll see you tomorrow.